Mexico suffered a currency crisis in December of 1994 that is often referred to as the Tequila crisis. The peso fell from a value of 4 pesos to the dollar to over 7 pesos to the dollar in just a single week. The crisis was mitigated to a good extent by a large loan from the U.S. government to shore up Mexico and protect against contagion. Even so, Mexico GDP fell by more than 6% in 1995 before finally growing again in 96. In this video, I'll discuss the different reasons behind the crisis. In a subsequent video, I'll talk more specifically about the crisis and its fallout. Mexico underwent serious economic reform in the 80s and early 90s. The government opened up the economy to international competition, privatized most state-owned enterprises, and generally regulated the private sector less. The government also pegged the peso to the US dollar to keep inflation expectations in check and reduce investor uncertainty about exchange rate fluctuations. They combined this with tight monetary and fiscal policies and an explicit agreement with labor and business to keep prices down. This agreement was called the Pacto, and it was negotiated yearly. The government was expected to uphold its part of the obligation by not running the printing press. Businesses were to try to keep prices down, and labor was to withhold demands for higher wages. It was one of the very few heterodox anti-inflationary plans that actually worked. The magnitude of the reform and the seriousness of the government's intentions convinced investors that Mexico was the country to invest in. As we will soon see, capital flows into Mexico during this period skyrocketed. While it's easy to see why investors were enticed by Mexican reform, the economic results were actually quite lackluster. Mexican GDP growth in the early 90s was about 2.8%, much less than other star performers in the region, say Chile at 7.1% and even Colombia at 4.1%. Productivity growth was relatively stagnant, exports had yet to take off, real wages were still not back to their 1980 level, and there was still a lot of poverty and inequality in the country. Despite this, international financial institutions talked of the success of reform and touted what was called the Mexican miracle. Just before the currency crisis hit, the IMF director praised the government for its, quote, fundamentally sound economic policies and predicted a growth recovery in the near future. It's not totally clear why the IFIs were so determinedly upbeat in their outlook on Mexico. It's possible that analysts were so convinced in the power of the reforms that they thought results were sure to come soon. There were some dissenters, but they were overwhelmed not only by the IFI optimists, but also by vocal proponents of NAFTA in the U.S., who spoke of the Mexican miracle when trying to persuade recalcitrant legislators of the benefits of signing such a treaty. As a quick reminder, the capital account is part of a country's balance of payments, and it's a record of all transactions between the citizens of the country and foreigners that involve a change of ownership of an asset. So it provides a look at the inflows and outflows of investment for a particular country, such as foreign direct investment, holdings of stocks, bonds, loans, and foreign currency. Economists have debated when is the optimal time for developing countries to open up their capital account. If countries allow the free flow of investment into their country and they attract a lot of money quickly, this could lead to a serious appreciation of the real exchange rate and make it difficult for domestic producers to export. Mexico removed capital controls almost completely in the late 1980s. The combination of opening up the capital account and the touting of the Mexican miracle meant that the country attracted a large amount of foreign investment. For instance, in 1993, net capital inflows into Mexico equaled more than 8% of Mexico's GDP, and most of this was short-term investments. And short-term capital flows, such as investments in stocks and bonds, means that investors can pull their money out of a country quickly if they get spooked. As we will see in the Mexican case, massive outflow of capital can wreak havoc on an economy. Given that large inflows of foreign capital can be potentially destabilizing to an economy, the question is whether the Mexican government was worried at the time about the situation. At least publicly, they claim not to be. Specifically, they argued that the large inflows were not concerning because 1. They had built in flexibility with the exchange rate since they had transitioned from an exchange rate peg to a more flexible type of peg, where the peso could fluctuate within a prescribed range, and the ceiling on this range was periodically changed. The government argued that this increased flexibility allowed them to take care of overappreciations of the real exchange rate relatively quickly. 2. The money that came from private investors was reacting to reforms that the government had enacted, and thus was to be expected. In fact, the government claimed that it was natural that reform would lead to an appreciation of the real exchange rate because the economy's fundamentals were better, especially now that NAFTA had been signed. Sebastian Edwards points out that even if this were true, however, the government couldn't escape the fact that capital inflows of more than 7% of GDP were not sustainable in the long run. Just like the Mexican government, most investment bankers and financial reporters seemed unconcerned about the possibility of a currency crisis. Sebastian Edwards finds that out of 20 written analyses released by major institutions during November and December of 1994, 12 dismissed the possibility of devaluation, 2 predicted an appreciation, 2 urged an upgrade of its rating, and 8 argued that although the current account deficit was very high, there would be no devaluation. For instance, Bear Stearns argued in November 94 that, quote, "We expect a strengthening of the peso in the coming months." Around the same time, J.P. Morgan wrote that, quote, "We view Mexico as investment-grade risk. We do not regard Mexican debt to have predominantly speculative characteristics." The result was that between 1990 and 1993, a total of $91 billion of investment flowed into Mexico, representing more than 1/2 of all foreign investment going to Latin America in the period. So what were the causes of concerns? Well, there were a couple of political events that sent investors fleeing Mexican assets in 1994. First, there was the Zapatista uprising protesting NAFTA, among other things, in January. And then, 2 months later, the ruling party candidate for the Mexican presidency was gunned down in a campaign event. And later in the year, the Secretary General of the PRI was assassinated. Financial authorities were finding it difficult to roll over their peso-denominated government bonds, or CETES. They could offer higher interest rates on the bonds to make them more attractive to investors, but they knew that doing so might send the economy into a recession, something they were pretty keen to avoid in an election year. Instead, they could issue dollar-denominated bonds, or peso bonos, to roll over the maturing CETES bonds. They wouldn't have to raise interest rates because investors would no longer be worried about exchange rate risk. Repayment of the peso bonos would be in dollars and not in pesos. Government chose this option, but in what turned out to be a continuing mistake in 1994, they disclosed very little information about what was going on or what they were thinking to investors. And note then that the interest rate spread between the peso bonos and CETES was a measure of the risk the market saw of a peso devaluation. Mexico was facing a number of different problems. Despite the passage of NAFTA, Mexico was starting to look much more risky after 2 high-profile assassinations and the left-wing uprising in the south. Investors were concerned about what kind of policies the new government would follow and were less anxious to lend until then. Also, it was increasingly clear that the Mexican peso was overvalued due to the increased capital inflows. 2 prominent U.S. academics argued that the peso was overvalued by at least 30% and needed to be devalued. There was also the problem that the government was running out of foreign reserves, and this is the crucial element. To prop up the value of the peso and prevent it from devaluing, authorities were using foreign exchange, that is, foreign currency, to buy up pesos in the marketplace. Unfortunately, that meant that there was an ever-decreasing amount of reserves, especially since exports were stagnant and not generating much foreign currency. By the end of November, foreign reserves equaled $12.5 billion. The problem was that short-term debt was more than $27 billion, and 70% of this debt was in the form of dollar-denominated peso bonos. So the government lacked the money to pay back these securities. And if they devalued to try to spur exports, that would make it only that much more costly to pay back the peso bonos. So when the government lacks the foreign reserves to defend an exchange rate peg, that is, to buy the domestic currency at the price it promised, and cannot or will not raise interest rates enough to attract more investment, then a currency crisis ensues, exactly what happened in Mexico. And in the next video of this series, we'll talk about the different options that the Mexican government had, which one they chose, and what the fallout was. All of the information in this video comes from an excellent 1998 paper by Sebastian Edwards called The Mexican Peso Crisis: How Much Did We Know and When Did We Know It? In the World Economy. I would highly recommend taking a look at this article for more information on the issue and also for more technical details of the situation.